All right, so I'm inside of the Fidelity's application for um, trading. So I think it's like Trader Pro, but the app. I'm already logged in. I'm already looking at an actual stock, and what I wanted to do today was walk you through how to sell a put. And for the option, or for the example I'm going to use is what. And what we'll do is we'll start out with selling a put. It's right now trading at $1.10, and in the last 5 days, it looks like it's hovered above $1 for the last 5 days. Let's see, for a month, it dropped below $1 about 1 month ago. So what I'll do is we're gonna go to option chain up in the upper right. And what this will do is it will show us it's set for all strikes, calls and puts, calls on this side, puts on that side, and the dates for expiration. Now, if I wanted to see more dates, I would click on this and I can add in additional dates. Apply. Okay, so we can see here that the expiration date is at the top of the chart for each one of these tables. And you can see the further away in the expiration date I get, the higher the amount I can get for the put. Now, if I go on here and I say, hey, the May 20th, the May 20th put is currently going for $15 a contract is what I can make if I get into an agreement saying that I will buy 100 shares of Watt if it goes below $1, right? So what we'll do is we'll go ahead and do it. So that's the expiration date, that's the strike, and this is going to be the price of the contract, and this is going to be a put. So I'll tap on it. It's then saying, hey, here's my delta. It's got a 32% chance of being in the money. And then if you want to understand your Greeks, definitely look into a video that talks about the option Greeks, because it will then explain what each of these mean. But what we're going to do is we want to sell a put, so we're gonna do we'll do two contracts, right? So we're gonna do two contracts, and we're going to sell to open. So we've got the two contracts. That information is shown here, right? That's one leg. So I've got level 4 option trading, so I can do multiple legs. I can sell some, buy some, create butterflies, condors, spreads, whatever. But for this example, I'm just going to show you how to sell a put. So we're selling I'll draw it. So we're selling two contracts. It's sell to open with a expiration date of May 20th, and the strike is $1, and it's a put. So that's what it's going to look like when you're creating it. The action, the quantity, expiration date, the strike price, and if it's a call or a put. And what you're looking at right here is this is the current bid and ask price for this contract. If I put it at market, if I leave it at market, I am going to get $10 per contract, because that is the current bid. Now, if I want more money than the $10, you can see right here, the highest ask is $15. That means that if I put it at $15, I would have to wait until someone wants that position that bad that they're willing to pay the extra $5 over, or the amount over what the current bid is, that's the market. This is going to be a limit order. So if I go here and I choose this to a limit order, it will then ask me for what the price is. And at that point I can do like 0.15. And now I'm putting it at the ask. But that's not what I'm going to do. Today, just to speed stuff up, I'm going to put this as market order, which means I'm going to get that per contract for it. Now keep in mind, when you do a put, right, a cash covered put, your brokerage is going to set aside enough money in case this needs to exercise and you need to buy 200 shares of that underlying stock at the strike price, $1 a piece. So again, that's the contract. Okay, I'm going to leave it at market, so that's what I'm going to get for it. Time to enforce day, and I'm using my margin account for it. So with that being said, I'm going to hit review order, which is right there. And I don't have a short position. So if I sold a short, then I would be able to buy back those shares using this contract. But because I don't have any sold short positions, it's giving me that little warning. Hey, this is not covered by a short position. So when it does exercise, it's going to need to be covered by cash. And again, that's going to be the stock, the expiration date, and the strike price. And it's sell to open. This is very important. When you're doing this, make sure you have the right thing set. So you don't want to accidentally buy to open when you're trying to sell these things. So make sure you pay attention to that. So right there, the order value is worth $20. They're going to take a commission of $1, which means that I'm going to get $19 added to my account because I sold this contract. Someone paid me for it. I got extra 18 bucks, or a total of 18 bucks from the deal. So I'm going to hit place order once everything looks good. And the order is received. It will take you to a transaction page where you can then find it on recent orders, and you can see where it's at. And again, to read this, this is showing that it's a put. That's the strike of $1. And this is the expiration date, and that is the actual stock ticker. So we're looking at the current contract that I have right now, or the two of them. So right here, if you go into it, it'll show you that there's two contracts. That's the most recent value for it. So I received a total of $26. So there was a price improvement. Or no, hold on, let me back up. Previous value is $20. Most recent price was 14 per. So yeah, I did get it at a little bit better deal, but it looks like the value of it has gone down for me and up for whoever purchased it from me, which as the stock price goes down, these put contract values go up because it gives you that protection. If the stock was to go up, then the price of the put contract I sold would drop. So then the put price goes down, and that's because the higher the stock is, or the further away the stock strike price of $1 is from the actual share price, then that put contract is going to be worth less and less. The closer it is to the strike price being the stock price, the more valuable it is. And if your strike price is above the stock price, so let's say the stock price goes down to 25 cents, then this put contract is going to be worth a lot more money because I'm essentially buying someone's shares that are now worth 28 cents for $1 a piece. So it's going to be worth way more for them. But let's see. So this is going to cost me a couple bucks, but I'll show you right here. So what we did was we sold to open a put, and what I'll do now is I will do what's called buy to close. So I'm going to buy back the 2 put contracts that I sold. So I'll go right here to trade. So we'll get this trade window, and what I'm going to do is you've got options. You can roll your sold put to a different date, which that's in another video. I'll put the link down below. Or you can take your put that you sold and buy it back. What I'm going to do is I'm going to show you how to buy it back. So what the option that you're going to choose is going to be buy to close, because you're buying a option that you had sold to open. So buy to close, the quantity 2, okay, and then this is the expiration date of your contract that you're buying back. This is the strike price, and this is if it's a call or a put. And again, when you're looking at this, if I put this contract at market, I'm going to get about $10 a share for it. If I ask for the higher amount, or I'm going to have to pay $10 a share, or sorry, the ask is 15. So let me back up. If I put this at market and I'm buying to close, then I'm going to be buying it. If I put at market, I'll be paying the ask price because I'm buying it to close, which is opposite of selling to open, right? If you're paying attention from earlier. So what I'll do is I'll leave it at the ask of 15, so that way it executes. I'm probably going to lose, what, $6-7. So if you're watching this and you like the info and it helped you out, you know what to do. But just to show you how it works, I'm going to leave it at market, data in force. Type for me is going to be margin. For you, it might be cash. It's up to you. But I'm going to go down here, and then now that that's in, I'm going to click preview order. So that's nice. If it executes at less than $65, because that's 65 cents times 100 shares, it will be commission free, which is fantastic. So I won't have any fees. But let's go ahead and go down. So you can see I'm buying to close 2 contracts at the market price. Okay, 2 contracts. Estimated value, I'm going to get $30 for it. Oh, okay, so I guess I made a couple dollars. And what I'm going to do is place the order. And there it goes. So on here you can see that I sold to open. It filled at 14, right? 7 minutes ago. And then, what? 1 minute ago, I bought back those 2 contracts, buy to close, and I had to pay 15. So I lost $1 on that. But at least now you can see how you buy and sell put contracts on companies. Like I said, hopefully this helps you in your Fidelity account. If you can, as always, like and subscribe if you want to see some more videos or get some more tips on this stuff. And if there's anything you do want to see that's crazy out there, just let me know and I'll make a video on it. All right. Bye.